The excitement of Diwali had just died down. It had been a decent one for business. Online retailers were reporting strong sales. Footfalls in malls were healthy. The hope was that a good monsoon will push up rural sales to help complement steady urban demand. It was important for the economy that the Indian consumer remained upbeat. For Indian businesses were anything but. A build-up of debt on corporate balance sheets and a pile of bad loans on bank books had meant that private investment was near absent. This, despite 175 basis points in interest rate cuts under Raghuram Rajan, who just 2 months ago had abruptly announced his departure from the central bank. There were other niggling issues facing the country and its economy, such as the persistent and inexplicable increase in cash usage and currency in circulation, and tensions at the border with Pakistan. This was the backdrop against which came an alert that the Prime Minister would address the nation on the evening of November 8th. Was it about military tensions, a new scheme, foreign policy? What followed took the nation, perhaps even the world, by surprise.
To break the grip of corruption and black money, we have decided that the 500 rupee and 1000 rupee currency notes presently in use will no longer be legal tender from midnight to night, that is 8th November 2016.
A quick look at the data confirmed the worst fears. 86% of the country's currency would now be invalid. The implications? Cash transactions would come to a virtual halt, growth could plummet, and cash-driven sectors like real estate and gold could take a severe beating.
When nearly 90% of currency in circulation in an economy is extinguished overnight, it is first and foremost a liquidity shock. A liquidity shock tends to impact certain sectors much more than the rest. So when we want to measure the economic impact of demonetization, it is perhaps important to measure the impact on sectors that get affected through liquidity shocks the most. In India, the three sectors that tend to get impacted the most are agriculture, manufacturing, and construction that also employ the most number of people. Using data from the Central Statistical Office of nominal gross value added, GVAs, of these sectors, it is possible to analyze quarterly GVA growth of these sectors before and after demonetization to come up with an estimate of the impact of demonetization. In the 3 to 4 quarters before demonetization, these three sectors were growing at a steady state of about 8%. In the quarter immediately after demonetization, this growth fell to 6.7%. In the subsequent quarter, it fell further to 2.5%. In absolute values, this means an output loss of nearly 1 lakh crores. That is, had there been no demonetization, and if we assume that these sectors could have continued to grow at the steady state of 8% in nominal terms, then because of demonetization, we've had an output loss in these three sectors alone of nearly 1 lakh crores in the 2 quarters post-demonetization.
There was almost no precedence to demonetization at this scale. In India, this had been last tried in the 70s, at a time when the Indian economy and its banking sector was smaller and less complex. Countries in Africa had tried it in the face of hyperinflation. The concern immediately after the announcement was how the banking sector would manage a currency exchange program this large. Bankers had been given no indication of what was coming. They'd been invited to gather together and watch the Prime Minister's speech, bankers told BloombergQuint on condition of anonymity. The news was as much a surprise to them as anyone else.
November 9th, a bank holiday, but was a day of frantic planning. War rooms were being set up, strategies were mapped out to deal with the currency exchange program, which was spread across 142,000 branches and nearly 2 lakh ATMs. The exchange was to be handled by more than 13 lakh bank employees spread across branches in India. The load on the branches was expected to be at a peak when banks reopened on the 10th of November. But the new rupees 2,000 and 500 rupee currency notes were yet to reach a majority of the banks. So branch managers had to do with what was available, which were low-value currency notes. Bankers also quickly realized that they would have to recalibrate the ATM networks because the new currency notes had different dimensions than that of the old ones.
No matter how hard banks strategized, they couldn't prevent the chaos that followed.
बच्चों की स्कूल की छुट्टी कराई है हमने उनको साथ लेकर के आए लेकिन अभी तक कुछ नहीं ना पानी ना खाना कुछ भी नहीं है सर कैसे इस तरह बात बनेगी 4,000 में शादी होगी 3 शादी 4,000 में होगी मेरे घर में 3 शादियां हैं बताओ वो कैसे करूंगा
Well, it's very sad because I had to leave all my goods back and I had to just buy what I had in my purse with my 2 rupee notes and my 50 rupee notes.
आम आदमी को बहुत तकलीफ हो रहा है लाइन में खड़ा होकर पैसा अवेलेबल होना मांगता है तो बहुत कुछ अच्छा है।
मोदी जी ने काम ठीक किया लेकिन थोड़े से आदमियों को एक मगरमच्छ को पकड़ने के लिए तालाब का पानी सुखा दिया जिसमें मछलियां भी हैं चिड़ियां भी हैं काफ़ी योग्य सबको काम आता था ये गलत हो गया।
Along the way, instances of corruption cropped up. Some banks saw instances of branch staff colluding with others to deposit black money in dormant bank accounts. There were reports of currency exchange limits being violated. Investigative agencies conducted visits and even detained some branch employees. These aberrations were perhaps inevitable in an operation of this scale. Amidst the chaos began the debate over who had recommended that 86% of the country's currency be scrapped with seemingly minimal preparation. The Rbi Act suggests that the central bank is the primary authority in matters of currency. The Act reads, the bank shall have the sole right to issue banknotes in India and may, for a period which shall be fixed by the central government on the recommendation of the central board, issue currency notes of the government of India supplied to it by the central government. It adds, the central government may, on the recommendation of the central board, direct the non-issue or the discontinuance of issue of banknotes of such denominational values as it may specify. However, other provisions in the Act seem to suggest that the government has overriding powers, such as this one, which reads, the central government may, from time to time, give such directions to the bank as it may, after consultations with the governor of the bank, consider necessary in public interest. Soon it emerged that former RBI Governor Raghuram Rajan had actually advised against such a move. In his book released in September, Rajan clarified his stance. I was asked by the government in February 2016 for my views on demonetisation, which I gave orally. Although there may be long-term benefits, I felt the likely short-term economic costs would outweigh them and felt that there were potentially better alternatives to achieve the main goals. I made these views known in no uncertain terms, but at no point during my term was the RBI asked to make a decision on demonetisation, wrote Rajan. While remaining tight-lipped on his discussions with the government, in an interview to BloombergQuint in September, Rajan laid out the economic costs of a move such as demonetisation.
Let me just say, again, wearing my sort of economist hat, that the immediate effects, if you haven't printed the transaction money that would be needed, is of course a chilling of transactions that are done in cash. I think that accounts for some of the fall in growth we've seen. Of course, we are measuring more the formal sector. We don't measure the informal sector, but the informal sector comes back to the formal sector through various kinds of demand.
BloombergQuint spoke to a person familiar with the matter who spoke to us on condition of anonymity. This person explained that in early 2016, the RBI had given a document to the government. This document laid out various scenarios of preparation and the expected economic impact. These scenarios range from necessary preparation to desirable preparations. A key parameter used by the RBI was the amount of currency, new currency that is, that it would have in hand before notes of 500 and 1000 were scrapped. Now, entirely unrelated to all of this, way back in 2014, the RBI had toyed with the idea of introducing 2000 rupee notes. This was being considered against the backdrop of high inflation, which erodes the value of currency. The government was aware of this plan, and in 2016, it asked the central bank to go ahead and print 2000 rupee notes. But it advised the central bank not to release this currency into circulation, but to stock it instead. All of this is information that we have got from this person who spoke to us on the condition of anonymity. Now, there came a point where the value of stock 2000 rupee notes went above the minimum preparation suggested by the RBI. Once it went there, the government said it was ready to pull the trigger and announce demonetisation. The value of 2000 rupee notes in hand with the RBI on the 8th of November was rupees 5 lakh crore. This is information revealed in response to an RTI query by an activist. Now, the RBI felt it had no option but to go ahead with the government's plan on demonetisation and implement it, since the final decision on demonetisation was within the purview of the government. This decision was taken to the Central Board of the Reserve Bank of India, which discussed it and debated it, but it did not vote on it because there was no precedence of voting at the Central Board level. Over the decades, the old lady of Mint Street, as the RBI has come to be called, has been seen as one of the country's strongest institutions. There have been times its actions have been criticized, its independence debated, but rarely has its competence been questioned. To the outside world, it seemed like demonetisation had pushed the central bank systems to the brink. An initial set of instructions to be followed during the demonetisation period was followed by a barrage of circulars making adjustments to the rules. Among them, a 14th November circular saying that district central cooperative banks would not be allowed to accept old notes. On November 21st, a circular allowed increased cash withdrawals for weddings and also increased cash availability for traders of agricultural produce. On November 23rd, the RBI stopped the deposit of old notes into small savings schemes. The circulars continued through December as the deadline to exchange old currency notes approached. On December 19th, the RBI said the deposits of old currency notes would be capped at rupees 5,000. Anyone wanting to deposit more would need to give a reason. An uproar followed and the central bank was forced to withdraw that circular just 2 days after it issued it. The flip-flops drew the ire of many and even earned the Reserve Bank of India the dubious distinction of being called the Reverse Bank of India. Former central bank veterans, who usually resist public commentary on their alma mater, also felt compelled to speak up. It is indeed a sad day to see one of the most respected public institutions in India becoming an object of ridicule and scorn, wrote former Deputy Governor Usha Thorat. Another former Deputy Governor, K.C. Chakrabarti, however, defended the central bank. They shouldn't be blamed. After all, it was the government's decision, Chakrabarti told BloombergQuint.
No way, Reserve Bank was not at all on the board. Reserve Bank only implemented whatever government wanted, asked them to do that.
The person BloombergQuint spoke to about the process said that the RBI reacted to on-ground conditions, but much of what played out was anticipated. The withdrawal limits had been planned and were staggered as expected. The government sought changes in some rules, such as the increased withdrawals for weddings, in response to public sentiment, said this person, who spoke on the condition of anonymity and is familiar with what was going on at the time. But did the central bank fail to manage public perception?
We must recognize that we are perhaps at a very important juncture in the history of the RBI in terms of its functioning. The RBI now has an explicit inflation target to achieve. RBI now also has a monetary policy committee to decide monetary policy. These are big landmark changes. For the RBI to achieve its inflation target, inflation expectations of people become very important. People's inflation expectations is a function of their confidence in the central bank to control inflation. If people trust and believe the RBI, their expectations of future inflation will be tempered. which will then impact actual inflation. Hence, the need for trust and confidence of the RBI among the common person becomes much more critical and important now than it was earlier. In this context, I'm afraid demonetisation achieved the exact opposite for people's trust in the RBI. I fully understand that the RBI may have been caught entirely unawares and had to respond on the fly during the entire demonetisation period. But with its constantly changing rules, inability to reveal the amount of money returned quickly, the long lines for withdrawal of one's own cash reflected the haplessness of the RBI, which can dent people's confidence in the institution. So yes, the RBI has suffered some institutional damage, which may be due to no fault of theirs, but ironically comes at a time when people's confidence in the RBI as an inflation targeting institution was needed to be strengthened and not weakened.
Even as the Reserve Bank was scrambling to manage the logistics of the currency exchange program, another problem cropped up: the actual count of the currency that was being deposited. One of the perceived objectives of demonetisation was to hit the stock of black money that may have been held in cash. While black money can be held in real estate, gold, or foreign bank deposits, the assumption was that at least a part of it would be in cash in India. If that cash did not come back into the system, it would lead to the destruction of that part of the stock of black money and may even lead to a special dividend for the government. Or that was the hope. Some, like SBI Economic Research, estimated that 2.5 lakh crore of the 15.4 lakh crore in currency scrapped would not return to the system. In the initial weeks, the RBI was releasing the count of currency deposited, but the updates stopped abruptly. The data was finally released in the RBI's annual report. It showed that 99% of the scrapped currency had come back into the system. Hopes of a special dividend were also dashed. The central bank's accounts showed a spike in costs on account of printing notes at an unprecedented scale and managing the surplus liquidity that flooded the banking sector. The result, a much lower dividend from the RBI to the government. A second person familiar with the matter, who also spoke on condition of anonymity, explained that cash had come back into the system in a variety of ways. Smaller unaccounted for deposits were simply split between those who may have had accounts but not much cash to deposit. That's one reason why Jan Dhan accounts saw a spurt in deposits during the demonetisation period. Other people used cash to prepay their loans and also started to put money in insurance premia. Each of these segments saw an unnatural spike during the demonetisation period. But the larger chunks of unaccounted cash were laundered using shell companies, said this official, speaking once again on the condition of anonymity. He explained that a lot of these shell companies were showing high cash in hand on their balance sheets. So those who had cash to deposit simply, in a manner of speaking, bought these entries and got that cash deposited via the shell companies. Since then, of course, the government has cracked down on shell companies. The IT department is also looking through and scrutinizing a lot of accounts to see whether it can nab those who may have deposited unaccounted for cash. Preventing the cash from coming back into the system was always going to be hard. Kenneth Rogoff, professor of economics at Harvard University and the author of Curse of Cash, told BloombergQuint.
I think that was very hard to avoid, because the problem is when you're doing something so dramatic that affects the economy so much, there's collateral damage going on all over. So in the end, the government isn't able to tediously check everyone as they bring cash back. That part of it's just not realistic. The real object should be to try to restrict the use of cash in the future, to make it more difficult to buy a house or an apartment, to make it more difficult to avoid taxes. And I think this is a step in sort of shaking things up, making people know that the government's committed to trying to restrict the use of cash. But I think the idea that you would be able to seize the black money is too optimistic.
A year has now passed since demonetisation was announced. Some of the dust has settled. So was it all worth it? The government certainly seems to think so.
November 8, 2016 would be remembered as a watershed moment in the history of the Indian economy. This day signifies the resolve of this government to cure the country from the dreaded disease of black money. In an overall analysis, it would not be wrong to say that the country has moved on to a much cleaner, transparent and honest financial system. Benefits of these may not yet be visible to some people. The next generation will view post-November 2016 national economic development with a great sense of pride, as it has provided them with a fair and honest system to live in.
But the answer changes based on your choice of data. Growth slipped in the January to March and April to June quarters, but the impact of demonetization is expected to wane as time passes. There are some lingering fears, though, that supply chains may have been disrupted twice over, first by demonetization and then by GST.
I think the best way to appreciate that this could be a temporary adverse supply shock is to look at the data. In the last quarter, where GDP growth slowed from 6.1% to 5.7%, the current account deficit quadrupled from 0.6% of GDP to 2.4% of GDP. Now, the widening of the current account deficit was not because of largely because of weaker exports or oil imports or gold imports. 70% of the widening was because very strong, broad-based increase in manufacturing imports. So the puzzle is, in the last 6 or 7 months, imports have been growing at 15% a year when growth is slowing, compared to the fact that for the previous 2 years, imports were contracting at 5% a year. So how does one reconcile the fact that at a time where domestic demand is slowing, manufacturing imports are increasing, and they're very broad-based in nature across multiple sectors? Our rationale is that this is, demonetization and GST have likely disrupted supply chains that involves the informal sector, small and medium enterprises. I mean, ultimately the whole goal of these reforms is to push the economy to become more formal. So the near-term cost is some of these informal firms have likely been affected, and as a consequence, larger firms that used to rely on these SMEs have had to import what they were previously purchasing at home, and that's how you explain weaker growth and this broad-based acceleration in imports over the last 8 or 9 months.
On the positive side, currency in circulation is lower than it was before demonetization. Fund flows into bank deposits and financial assets are higher, and digital transactions have increased. But did demonetization achieve the objective of hitting the black economy? And has it changed the cash-loving behavior of Indians? It may take years to answer these questions with any degree of conviction.
So 1 year after demonetization was done, the million-dollar question, was it worth it? I think it's a complex answer that can be given. It can't be a simple yes-no kind of answer. The biggest positive of this exercise possibly is the fact that the ownership of cash in the economy was established almost 100%. Now, there was an expectation earlier that about 20-25% of the cash would never return. I, for one, never subscribed to that point of view. I was sure that every penny and rupee would come back, as it did. But the pro here is that you now have an ownership of every rupee in the economy. Earlier, you would not know who owned the cash. Now, that doesn't mean that all of this cash is legal or illegal. The government is talking about another benefit, the fact that almost 3 to 4 lakh crore rupees that were put back into bank accounts are somewhat suspicious. Now, going from somewhat suspicious to establishing outright illegality is going to be an extremely onerous job. It may require years of investigation. It may also require arm twisting and coercion, which could actually not be fair on a person who may turn out to be the honest owner of that wealth. So while this is spoken of as a positive of demonetization, I am a bit unclear whether this could become an instrument of coercion. Whether actually the gains from this in terms of establishing the illegality of that cash are going to be that enormous. So therefore, if you ask me, the fact that we've established ownership is a positive. Whether we've established illegality of the dirty cash in the economy, I'm not so sure that will be so easy to prove. Other than this, it's going to be very difficult to figure out what more could be a pro. Yes, there has been a fairly big behavioral change because people are now a bit wary of dealing in cash. Therefore, the propensity to hold that much cash has come down. The propensity to do transactions which are digital or are through checks has gone up. Now, did we need the kind of coercion that we did to achieve this end? The jury again is out. Perhaps if we had relied on normal economic growth, stepped that up, normal education, incentives, disincentives, we could well have reached this point without going through this sort of disruptive move. But the fact that there has been a behavioral change can also be marginally put in the positive category. Some people are now stretching that behavioral change argument to say that the kind of increase that we've seen in the inflows into financial savings, into equity mutual funds, debt mutual funds, bank accounts, that too can be traced back to this behavioral change. I think that's a bit of a stretch. I think again, as incomes go up, as economies develop, as GDP growth accelerates or reaches a threshold above 5 or 6%, and people do tend to put more of their savings into financial instruments. So I think that's a natural trend. To say and link that to the behavioral change towards cash, which got kick-started or which got almost forced through demonetization, I think that link is a bit tenuous. Beyond this, if you ask me, were there any gains? I think you can well nigh say no. Did we need to go through all the deaths, the pain, the supply chain which went completely awry, people losing their jobs, people having to live without cash, poor people having to do that, people in villages with very little access to banks and post offices, who were denied therefore access to their own cash? Did we have to go through all of that pain to reach those two positives or two quasi-positives that I just listed? I'm not so sure, because the list of the cons is very large. The list of the pros, as I said, stops at about 1, perhaps 1.5 positives.